In this module, we are going to learn about the basics of trading. We are going to start from what are stocks, what is a shareholder and how is he different from a partner in a company, what is a stock market and a stock exchange, what has been the history of stock exchanges since the time they started and how have they evolved over so many years. And finally, what's the difference between a normal trade and a short sell? And how do you actually place a trade? What happens when a trade is placed? How are the different systems and the ecosystems connected? So let's begin. What is a stock? A stock is a share in the ownership of the company. When you buy a stock, you buy a piece of that particular company. Owning a stock means you are entitled to the company profits and you can stake a claim on the company's assets. As you acquire more and more stock, your ownership in the company increases. The more the stock, the more your ownership in the company. So people often ask me this question, what is the difference between a stock, a share and an equity? So for your information, all of them mean the exact same thing. You can say you're stock trading, share trading or equity trading. All one and the same thing. Holding a stock means you are a shareholder in a company. There could be many shareholders of a listed company on a stock exchange. Now, what's the difference? And this is also often a common question where people get confused. What is the difference between a shareholder and a partnership? So let's explore these in detail. As a shareholder, you have limited liability in a company, which means you are not liable for the company's debts. If the company goes bankrupt, no one can stake a claim on your personal assets. All you lose is the value of your investment and that's it. Nobody will come running after you, staking a claim on your personal belongings and assets. Whereas, as a partner, you are liable to the creditors to pay the company debts. And if the company declares bankruptcy, shareholders and creditors can stake a claim on your personal assets. You are liable to pay the company's debts to the creditors. So here is a golden question, right? How do you make money with the stocks? Money with the stocks can be made in two key ways. One is from dividend payouts to the shareholders by the company management. Now, dividends are paid out usually by mature companies, by slower growing companies that do not need the money to invest in their business and hence they share the profit with their shareholders through a steady stream of financial returns called dividends. On the other hand, you can make money from company or from a stock investment by the stock price increase. This stock price increases because the company is growing extremely rapidly. Such companies are usually smaller companies that are faster growing companies and that need money to invest and reinvest in their business. Since they are investing money in their business to rebuild their business, to build it, the company valuation increases and hence the stock price increases. And that's how you make money as well. So now what is the stock market and how does it all work? Stock market is a place where the buyer and the seller meet each other and can trade stocks. Stock markets are usually represented in the digital format as shown in the picture on the slide. They are represented by a series of numbers where green shows the companies that are rising up, the red shows the companies whose stocks are falling. We'll get into those and the details regarding the falling and the rising stocks in the later chapters. For now, you need to understand that every company is represented by a series of numbers and their price movements, whether up or down. Stock markets used to be physical locations known as the trading floor. There would be lots and lots of people gathered in one space in a common area, just like shown on the slide, shouting and screaming numbers and stocks to each other. Stocks also used to be physical trading certificates, pieces of paper that would be traded and exchanged between the buyers and the sellers. However, with the digitization, this does not happen anymore. Today, stocks are traded through a PC where a broker helps the trader trade the stocks with the stock exchange. The broker talks to the stock exchange and enables a trade between various traders that go via the stock exchange. We'll get into further details in the next few slides. For now, just remember the diagram shown in the slide and how this ecosystem works. Now let's understand what a trade is. A common trade is when you buy low and sell high and hence make profits during that time. Let's take an example of Siemens. If you had bought Siemens on 16th of March, 100 shares at a price of 1004.60 and then sold them on 30th May at a price of 1222.35, then you would have made a cool profit of 21,775. So it's really simple. You buy low and sell high. Now the inverse of a normal trade is called a short sell. This happens when you sell high and buy low. Why is this done, you may ask? Why would anybody want to sell first and then buy later? Now this usually happens in a falling market. If the economy is on a downturn and the stock markets are falling, you still want to make money, right? So how do you make money off falling markets? In that case, you sell high and then buy low in falling markets. So you take advantage of this price movement and make profits. Let's take an example. Let's look at an ABB India stock and let's say you sold the stock at a price of 1148.05 on 19th October. You sold 100 shares and you bought them back on 21st November at a price of 1049.60. You made a profit of 9845 in falling markets. And this is how you take advantage of price movements in falling markets. This is it for now. In the next module, you will learn a few other key terminologies regarding what a portfolio is, what is portfolio diversification, and what are the traders and the investors, and what is the difference between the two types of trading styles. Till then, go on to trackinvest.com, explore the platform. You may also Google some of the terminologies you have learnt in this topic for an in-depth understanding of the key terms. All the best.